Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am your host, Christopher Cahill. Later on, AIMkts.com managing editor Alicia Purdy will be sitting down and speaking with Andrew Stephenson. But first, let's talk about China. In a Barron's article, December 15, 2014, about bilateral investment treaties, the struggle to negotiate and then later pass a bilateral investment treaty between China and the U.S. is detailed. Just a bit of data from the article. China currently restricts investment in about 100 industry sectors, ranging from manufacturing to services to agriculture. You can't just go and invest. You have to invest in those sectors or parts of sectors that China permits you to. The U.S. restricts foreign investment outright in only 5 sectors and maintains 24 mostly minor conditions or restrictions that would be removed if the U.S. is given reciprocity in China's market. And this causes me to turn to an article on AIMkts.com. Now, the Accredited Investor Markets website hosts this show. In addition, there is a great number of articles on that website, a great wealth of articles on that website, an investment glossary, and written interviews with investment experts, investment professionals, those who can dispense wisdom on various kinds of investments. And one of those articles is dated February 9, 2015. It's written by the AIMkts editors and entitled, China Calls Out to U.S. Investors. The article is actually fairly brief, quickly summarizes a main point from a larger piece, the main point being the Chinese government's effort to reform domestic financial markets and encourage more foreign investment. Linked to the article is a white paper from investmentnews.com. And that white paper is entitled, China and the World's Hottest Stock Exchange Beckons for American Investors. A somewhat ungrammatical title, but c'est la vie. Anyway, the article does talk about opportunities in China, that Chinese officials have approved Shanghai Hong Kong Stock Connect, a program that gives offshore investors significantly expanded access to securities traded in mainland China. So the movement is toward greater openness. And it is suggested, again, by the article that easing restrictions on foreign investment is part of a process known as capital account liberalization, which ultimately could lead to the full convertibility of the Chinese yuan. So perhaps that's really China's endgame, to turn their currency into a convertible currency like the U.S. dollar or the British pound. The article does caution, however, that investing in even newer exchange-traded funds offered through this program has its challenges. And I quote, some funds are limited in the amount of money they can deploy because they rely on licenses subject to government-imposed quotas. So what seems to be open access really isn't, because it's subjected to licenses which themselves are subject to government-imposed quotas. When you have a command economy, even one as recently liberalized and extensively liberalized as the Chinese economy, there's still a little bit of command, especially when you have a one-party state. Fidelity Investments is a U.S. investment company exploring active management in Chinese securities. And I quote, to manage its $1.4 billion Fidelity China Region Fund, the company employs a Shanghai-born analyst with a background in forensic accounting to inspect corporate governance and outside transactions involving the company and their relatives. This man is named Robert Bao, and he is the fund's Hong Kong-based portfolio manager. I read all that to set up a quote from Mr. Bao. Quote, you cannot take anything at face value in China, end quote. It makes the work so much more complex. Now, the complexity and unreliability and central control of the economy is underscored in various ways. The Risk and Compliance Journal section of the Wall Street Journal, dated January 30th, 2015, issued an article entitled "The Morning Risk Report, Chinese Regulators Choose Their Own Time to Strike." The article details how the Chinese government accused Alibaba Group Holding Limited, that's right, that Alibaba, of allowing counterfeiting across its giant online marketplace. Now, that accusation has since been managed by Alibaba with the use of large amounts of money, but that's not the point. The point is, and this is made in the article, companies may see enforcement on issues like corruption or environmental regulations dormant for years, only to get caught up in a sudden crackdown. And there was a Chinese pharmaceutical industry crackdown in which, after corruption being tolerated for a long period, led to GlaxoSmithKline PLC finding itself in the dock of a Chinese courtroom on bribery charges. The trial took just one day, leading to the conviction of 5 of its executives and a nearly $500 million fine. Now, why would the Chinese government do such a thing? Well, I suppose because it can. And there may be internal dynamics in the regime which account for why it makes a show of getting tough at a given time and at another time. And that is a darkling kind of description of China issued by me based upon a lifetime of watching China events, not that carefully. But there's somebody who has watched Chinese events more carefully, returning to Barron's, the December 8, 2014 issue, an article entitled "Why Beijing's Troubles Could Get a Lot Worse." Now, in this article, there's an interview of Anne Stephenson Yang. There's a hyphen there. It's a hyphenated last name, Stephenson Yang, who first arrived in China in 1985, so she's been there a good long time. She married a former People's Liberation Army intelligence officer, and she is herself fluent in Mandarin. She has worked as a journalist, a magazine publisher, software executive. She has run the in-country U.S.-China Business Council and is now research director of J Capital, which serves investors in China. Well, Ms. Stephenson Yang, you could summarize her opinion as, and I quote, "In my opinion, the press is somewhat guilty of a willing suspension of disbelief on developments in China." Now, her disenchantment with China is described as arising from the stark inequality of wealth and opportunity there. And I quote, "the, quote, thuggishness of the communist elite," end quote, and, quote, "the amount of chicanery and accounting fraud engaged in by Chinese companies and government organs," end quote. In Ms. Stephenson Yang's view, people are crazy if they believe any government statistics, which of course are largely fabricated. Further, Ms. Yang states that she puts much stock in estimates by various economists that actual Chinese GDP is probably a third lower than what is officially reported. She opines that she would be shocked if China currently is growing at a rate above, say, 4%, even though it's described as growing above 7%, and that is described as a slower rate of growth than in recent years. For Ms. Stephenson Yang, the real growth is 4%. Further, Ms. Yang notes that the economic malaise of China is evidenced by increasing capital flight from China on the part of wealthy Chinese and corporations using phony trade invoices and other ploys to get around the country. Further, Ms. Stephenson Yang points to other signs of economic malaise, including increasing capital flight from China on the part of wealthy Chinese people and corporations who use phony trade invoices and other ploys to get around the country's capital controls. And indeed, in a recent interview on this show, the president of Wealth Migrate, an international real estate investment firm headed by Scott Picken of Cape Town, South Africa, Mr. Picken estimated that 26 million Chinese nationals have sent money out of the country in amounts of $1 million or more to purchase foreign real estate, which somewhat supports Ms. Stephenson Yang's view. And as for the much ballyhooed anti-corruption campaign initiated in the first part of this year by the president of China, which included the accusations against Alibaba, and others. For Ms. Stevenson Yang, what's really going on is an old-style party purge reminiscent of the 1950s and 1960s with quota-driven arrests, summary trials, mysterious disappearances, and suicides, which is already entrapped, by her calculations, 100,000 party operatives and others. The intent is not moral purification, but instead the elimination of political enemies. But I'm sure there are other views on China. I just haven't surveyed them in this program. And I guess if one is frightened away from Chinese investing, and perhaps one should not be, but nevertheless, one might think of investing in art, and I wanted to point my listeners to a very interesting article on the dangers of investing in art. That's the title of it. It's in Bloomberg, February 12, 2015, by James Tarmy. In it, he talks about the fortunes of German artist Anselm Reyle, R-E-Y-L-E, whose signature crinkle pieces, in which colored foil is mounted on a painted canvas and then encased in glass, were all the rage in the early part of this century. However, when the financial crisis came in 2009, prices for Mr. Reyle's work fell and could not get up. One gallery owner said of Mr. Reyle's work that there was an independent momentum at work in the fall of Mr. Reyle's prices for his work. Quote, people don't like artists whose price goes down. Others have accounted for Reyle's decline with respect to overproduction, fickle speculators, and simply that some artists look interesting for a period. Maybe it's a month or maybe it's a year, but things sort themselves out. But fundamentally, the article concludes, no one wants to be seen overpaying for a declining asset. Which strikes me as a funny expression, because what it means is that purchaser of a set of images is investing in part in his own image in purchasing that set of images. So whenever one picks one's investment, one picks one's risks. And the art world and the Chinese world cannot be accused of having uninteresting risks. Now let's move on to the interview.
Hi, I'm your host, Alicia Purdy. With me today is Andrew Stephenson, the Director of Research Operations and Client Services at CrowdCheck. CrowdCheck is a due diligence and disclosure service for online alternative investments. Andrew leads a team of analysts conducting due diligence and producing reports on issuers seeking investments through online funding platforms. Hi, Andrew. Thanks for taking the time to talk with us today.
Thank you for having me.
We're going to talk today about various sources of online alternative investments for accredited investors and what investors need to know about security and the safety of their investment. But I want to start by talking a little bit about you. Can you tell our listeners a little bit about yourself? I know that you're a licensed attorney in California, and you spent some time working in Congress, which sounds really interesting. Can you tell us a little bit about that?
Sure thing. I started my career working on Capitol Hill in Washington. While Washington politicians get a bad rap, and many times deservingly so, being a congressional staffer is one of the most intellectually challenging and rewarding jobs a person can have.
I'm sure.
The role demands quick learning and an understanding of complex policy issues. I was in that role in 2007 and 2008 when the financial markets crashed. That experience has shaped my law school experience, practice as an attorney, and the attitude that I bring to CrowdCheck, which is that investors must be given the full and complete truth in order to make an informed investment decision.
Okay. Sort of springboard off that, you wrote an article for Accredited Investor Markets in the recent past, and I want to just get into that a little bit. And the wealth of knowledge you have behind you, I'm sure, is something that, like you said, has helped build these ideas out that we're going to discuss today. There are 3 ways you talked about, which were really interesting, in which an issuer can market its securities to accredited investors online, on its own, by the use of a passive bulletin board, and through a broker-dealer platform. And I just want to break down each one of those and expand on the piece that you did on Accredited Investor Markets, because I thought it provided some really excellent advice and things that maybe people aren't really noticing as much. They may swing to one side or the other or only heard of one thing. So we can kind of provide them a more well-rounded view of all these different options. So let's start with issuers who market securities on their own. What does that mean?
It's exactly what it sounds like. The change in the law that allows companies to solicit to accredited investors directly does not require any use of a third party. They can, on their own website, they can decide to sort of put up an advertisement that they are seeking investments. Hey, we have a great thing going. We're looking for money. Accredited investors, come and invest with us. So this is essentially the equivalent of the company putting a for sale sign in its front yard. There's no restrictions to how it can advertise, and there are no restrictions on what it needs to provide investors in order to make a sale.
It used to be illegal, but it isn't anymore. Is that correct?
Correct. It is no longer illegal. In the past, in order to have a private offering, that is an offering that is not registered under the Securities Act, that offer had to be entirely private or made only to people that the company has had a pre-existing relationship with. Now, under the new Rule 506C transactions, which is a safe harbor from the registration requirements of the Securities Act, the company can advertise as broadly as it would like to in order to find investors, with the one caveat that the actual sale of securities can only be to accredited investors. And the issuer has the obligation to confirm that those buyers are accredited. So that does require the issuer getting a statement from a lawyer, from an accountant, from somebody who has reviewed the financial status of the investor and can confirm that the investor is in fact accredited.
Well, that sounds very well and good, but is it too good to be true? What are the disadvantages of this sort of open season on accredited investors?
The disadvantage of having open season is that the marketplace can get crowded with companies that are not really ready for taking on outside investors. Bringing on outside investors requires and demands a certain maturity from a company. Not only must it do better about keeping records, it also needs to keep investors informed, and it needs to ensure that the investment that's being offered is actually legal and binding. That isn't always the case when the company is going about it on its own, because in the end, the company is doing its very best to run the company and become a profitable business entity. And many times they just don't have time to take care of the formalities that are required when they've brought on outside investors.
So they're obviously obligated to be in compliance with the SEC. Is that true in every case? Are they all? And if they're not, who's watching them and how does that affect investors?
For example, take the requirement of selling that the issuer can only sell to accredited investors. If the issuer does sell to a non-accredited investor in this offering that it's used general solicitation, it could cause problems for investors down the road. And so the violation could not only cause problems with regulators, it could make it more difficult for the company to raise funds in the future if additional capital is required, because they would potentially be prohibited from relying on this particular exemption from registration again, because they have had a violative securities offering.
Okay, well, let's talk about the second option for securities marketing through a passive bulletin board. So whereas the first one is sort of out there, and it sounds like everyone can do it, but they really can't. We know that it's limited to accredited investors, but everyone's going to end up hearing about it, whether it's on TV or the internet. A passive bulletin board is one I'm less familiar with. What is that? And as you're explaining that, can you tell us the benefits and the drawbacks of that as well?
So since the change in the law and the SEC creating the Rule 506C exemption from securities registration, it's the passive bulletin boards that have become the most prominent in this space, because they're easier to start up. They don't act with a license to sell securities. But by not having a license, they are restricted in what they can do. So passive bulletin boards function like a matching service. They are not quite finders because they have to take a passive role, but they allow issuers to use their facilities to solicit investors for their particular offering. The benefit to investors here is that it's easier to find and compare opportunities, because the bulletin board is going to have multiple entities that are raising funds and demonstrating that they have done what they need to do to seek investment. Many bulletin boards are also industry specific. So if it's life sciences or medical equipment or green tech, there are bulletin boards out there that have that particular focus. The drawback is that while bulletin boards may be able to use objective criteria for deciding which companies they want to allow on their site. So many will have listing agreements that do require the companies to meet certain standards. They are not allowed to truly vet the deal because doing so could constitute providing investment advice, which bulletin boards are actually prohibited from providing because of their status as not being licensed securities participants.
That actually goes right into my next question is, let's say I'm an accredited investor and I come to one of these passive bulletin boards and I'm looking for a great deal and I am reading through them. Is it safe for me to assume that they've done their due diligence and these are only things that are probably a great deal? If they say something that makes me feel more comfortable pursuing one opportunity versus another, is that accurate, or is that something that should not be happening on these bulletin boards?
There is a limited amount of diligence that they can, and many of them advertise that they do. Where it can get problematic for issuers is what that bulletin board is doing with that information. When it comes down to it, the basic rule is that they are prohibited from providing investment advice. And investment advice is an incredibly broad concept that goes beyond the sort of conventional understanding of a sort of professional who is providing sort of guidance on how to structure investments, what kind of investments to do, or that sort of thing. In the securities world, investment advice is really just, is this better than anything else that's out there? And if they are receiving compensation for that, then that is something that they need to be licensed in order to provide that advice. So in the context of bulletin boards, some of the problematic language is just anything that has a subjective tone to it. So for example, so is this sort of a great company, strong financials, experienced leadership? There are certainly objective information behind those terms can be objective, but the way it's being presented is in a subjective format of invest in these because they are better than what else is out there. Less obvious sort of forms of investment advice could be the platform identifying certain companies as being featured companies or top picks. So just by the way the site is organized, they could be inferring that certain investments are better than others. And the reason why this matters is that the rules surrounding offers and sales of securities provide a lot of recourse to investors if those rules have been violated. So in a bulletin board, if a bulletin board sort of is selling securities, but in a way that that bulletin board should have been licensed as a broker, investors who purchase through that bulletin board would actually have a right of rescission against the issuer. And so while this may not matter to individual investors who are happy with their investment, sort of see things progressing and like the progress of the issuer, other investors who have put money in may not feel the same way. And if they decide that they're not so happy and demand their money back, the issuer doesn't have a choice because the bulletin board has violated securities laws. So if they have to give the money back plus interest, that could cause problems for the issuer down the road if now they have a sort of sudden loss of capital that has to be paid out because they're liable to investors who have the right to receive a return of their capital contribution.
Does that happen often where there are those type of issues, or is that really more the exception?
It remains to be seen, actually. And this may be something that happens more because of the new general solicitation rules. In the past, private transactions were private, and investors putting money in had more control over how things were done. And you have fewer opportunities for these violations to occur because everything was sort of kept quiet. You didn't have it out in the open. Now that more of them are out in the open, it's possible that we will see sort of an increase in these types of activities. It's also a matter of the changing scope of the investors who are participating in this space. When it was a very sort of quiet, actually behind the doors in private offerings, there's a select group of investors. But as we're opening up to more investors through the general solicitation rules, there may be some out there who are not as experienced and are not don't do their own diligence and decide that they actually change their minds on a whim. So that's the challenge, is we don't know exactly what will happen. We just know what could happen.
Okay. I just want to ask you one more question about this one, about the passive bulletin boards, and then we'll move on to the third one. I was really interested in subjective language because it seems like it could be really subtle. Is it as easy as saying this is subjective language, this is not, or are there some things that investors can watch out for so they're not being swayed? Because I'm assuming that not every passive bulletin board is always at every time in compliance, or that maybe there are some that are really just truly fraudulent versus the really legitimate ones. If an investor is just sort of trolling the internet and they come across one, how can they know that they're being influenced? Is it something really truly overt, or is it just subtle enough that they could miss it and walk themselves down a path leading to problems later?
A lot of these bulletin boards model themselves on the popular donation reward crowdfunding sites like Kickstarter and Indiegogo. And those pages often do have these top picks, featured deals, or featured campaigns, because they're not deals, they're not investment opportunities. And that sort of featured language can become problematic because it does create a sense that there is a reason that this deal is better than something else, which gets into the territory of investment advice. Subtle. It has to be out there. It has to be present, and a reason that would change an investor's mind, or through this sort of subjective language or structuring, this particular deal came to the investor's attention more so than any other deal. Those are all the types of things that can create problems for platforms being in compliance with the rules.
Okay. Let's talk about the third way an issuer can market securities online, and that is broker-dealer platforms. Based on what we've just been discussing, are they the best option out of all three? What are the issues? And I know that it probably has its own. However, it sounds like the safest. Is that true? Can you expound on that a little bit?
Sure. Just say that, best is all relative because there are drawbacks to issuer using a licensed broker-dealer, specifically higher fees, which means that less of the capital contributed goes directly to the issuer. That said, brokers do have obligations to investor clients that include conducting due diligence on the issuer and sort of affirming that that this issuer is suitable for investment before it makes the opportunity available to investors. So while this does not take the risk out of investing in early-stage companies, it does provide some assurance that the deal has been vetted in some way before the investor begins his or her own diligence.
So a broker-dealer is someone who is licensed to provide advice. What other roles do they play for investors?
Brokers are able to promote deals in ways that other participants are not able to. They don't just have to be sort of a passive matching service. They can go out and promote and solicit and do all these things on their own as well, which can be beneficial for issuers in many ways because it can help the issuer raise funds it needs within the period of time that the issuer needs those funds. So a $500,000 capital influx over 1 month can have a very different impact on the issuer than $500,000 over 5 months. That could happen with it sort of a more passive setting where the intermediary is not able to promote the deal. So brokers also have sort of access to some more sources of funds and can help arrange sort of syndicates of investors in a way that can be beneficial to all investors involved.
Now, we all love the internet. It's done wonderful things, especially in the investment age as things are just starting to sort of come into their own with deals and deal flow and all of those great things. But on the opposite end of that, there are some major issues. How can an investor know that they're working with a real SEC-compliant broker-dealer versus being defrauded by someone who's deliberately out there, just get money and run away? And it does happen. I mean, there are plenty of stories of that, probably, of people who are being defrauded by someone who misrepresented themselves. And given that you may or may not work in person with someone like in sort of the old days, how can an investor know? Are there safeguards in place? Are there steps they should take to make sure that they're working with a legitimate person?
Yeah, in this, and when investing online, it's important that the investor does their diligence on anybody who is selling the security. So that includes all the intermediaries in addition to the issuer itself. So all broker-dealers and investment advisors are required to be registered with the Securities and Exchange Commission, state securities regulators, and the self-regulatory organization FINRA. FINRA does offer an online broker check that allows investors to confirm that the broker is in fact registered and if the broker has been disciplined for improper activities. What investors do have to watch out for are copycat brokers. Essentially, they choose names that are similar sounding to other entities in a way that try to sort of take advantage of their credibility while they themselves are operating sort of fraudulent business with fraudulent business practices. We haven't seen much of those in the space yet, but the potential is there. Right now, there are just a limited set of broker-dealers that are making offerings available through these online platforms.
Is there a reason for that?
I think it's just early days. It's been just over a year that the sort of 506C public general solicitation has been allowed, and a lot of brokers just have not entered the space yet. The last time that sort of the study was done on this topic, about almost $1 trillion was raised in the private capital markets relying on sort of Rule 506. But within that, only a small fraction was actually done through general solicitation. So it's still sort of small, still taking up a small space, but it's a growing space. And I think, and as it does grow, we'll see more brokers entering the space, more platforms, and more opportunities and choices for investors.
Well, now, given that, I do want to mention that one of the things Accredited Investor Markets always discusses is the investor's responsibility to do their own due diligence and sort of not taking someone else's word for it, but really at the end of the day, being the final say about where your own money goes and who you give it to. That being said, I want to transition for a second into talking specifically about CrowdCheck. At CrowdCheck, you work with a team of researchers to develop best practices for efficient and effective due diligence for small online securities offerings. So, knowing that you know what you talk about, can you please tell our listeners what effective due diligence means for investors and what it means for issuers, since they're sort of both players at the table?
Sure. So, yeah, so taking on investors, taking on outside investors, especially requires that the company sort of mature to a point that it cannot leave investors high and dry. So looking at company offering materials, is the company able to produce, and does that company produce detailed financial statements? Are any projections in those statements based on appropriate assumptions about, say, for instance, its market size? Is this a company that's sort of producing sort of a consumer gadget, but that instead its financials project based on assumptions about the entire consumer market out there rather than just consumer market for that particular type of gadget? So understanding what's in the financial statements, and are those financial statements sort of correctly done. Other things to look for are important things, especially for early stage companies. So do the company founders treat the company as an entity separate from themselves? For example, are there employment agreements between the founders and the company? Are there separate bank accounts for the company that are distinct from the founders? Is the intellectual property of the company actually assigned to the company, or is it still in the name of the founders? A lot of times, companies will, especially when it's tech companies, will be based around a particular patent it's with an invention that was perhaps invented by one of the founders, but has not yet been assigned to the company. That can be problematic if that founder decides to leave the company. We also have to look to see, is the actual investment going to be valid and binding? So this requires that the company's board of directors have taken the necessary actions to authorize the securities and approve the transaction. This is something that does require sort of following the chain of events of board of directors, knowing that all directors were validly appointed and that all directors that were required to approved the deal. We've seen a few instances of just that this was not done, and was not done for prior security raises as well, that then impacted future ones. And so this is, digging into sort of board minutes, not really a fun activity for an investor who wants to be more focused on the business and the prospects of the company. So at CrowdCheck, what we help do is highlight the objective information about the companies and bring important issues to investor attention. But when it actually comes to reviewing that information, deciding if this is a good investment at the offered price, that decision must be made by the investor, him or herself.
How often have you seen investors, I guess on either end of the spectrum, completely take your advice to heart or just walk away from it and do their own thing anyway? And what are the results of that? I mean, have you seen people where you say, look, this is a red flag, and they say, well, I'm moving ahead anyway, and then it ends up being the red flag was completely right? Does that happen?
We haven't seen that. When we're conducting our due diligence and working with issuers, we take a position of getting them to yes, getting them to the point that sort of identifying the issue, not letting them move forward until it's resolved. And so this is something that that those issuers actually have found to be beneficial as well, because they get sort of that extra protection, but then it just gives everybody extra confidence in what is occurring and with the offering going forward.
Okay, so you're really there for the entire process, and it sounds like that CrowdCheck is really protective of the person who's come to them for some answers.
Yes, that'd be a great way to describe it. We are trying to create private markets and small and early stage companies that are open and transparent and protect everybody involved.
I have to let you know that I was trolling CrowdCheck this past week and a little bit before that. You write a lot of pieces for CrowdCheck, and I saw a piece that you wrote last month about SEC violations, none too big or too small. Can you tell our listeners, what is the CrowdCheck Bad Actor Report? That was something I saw you mention on there, and I was really interested in it because as many wonderful opportunities as there probably are out there, I always have a concern about fraud, and I know that there's just many weeds in the grass as there are, blades of grass. Can you explain what the CrowdCheck Bad Actor Report is?
So the starting place is to know that if a company or any of its controlling persons, such as the directors or executive officers or significant shareholders, have previously violated certain federal state securities laws, then the entire private offering to accredited investors is prohibited from occurring. So if it does go forward, it is in violation of the securities laws with the ramifications that follow, including additional sanctions that would harm the company and potentially harm the investors, as they likely wouldn't be able to get there wouldn't be any money to get back. So in this past year, under the leadership of Chairman White, the SEC has significantly increased the number of enforcement actions against companies and people. So this increases the chance that a bad actor is potentially present by having more enforcement actions out there. So the Bad Actor Report helps those issuers who want to remain above board and comply with the SEC obligation to make a factual inquiry into whether a bad actor is present. For investors, they benefit from the Bad Actor Report by seeing for themselves as well that there are no bad actors here, and that would not be a reason for this offering to end up becoming disqualified, resulting in further sanctions from violating securities laws.
Right now, as we know, there are certain aspects of investing that are only open to accredited investors. And on AIMkts Radio in the past, we've talked with some others about non-accredited investors getting into the space. Does that affect CrowdCheck at all? And if so, what is it going to change or cause you guys to need to do to sort of keep up with? Are you going to get an influx of requests for reports, or what do you anticipate in there?
Yeah, so the rules are not yet finalized, but when they do, one thing we do know will happen is that the rules do contain a number of fraud prevention measures. So all offerings to non-accredited investors must go through securities intermediaries like broker-dealers, and issuers will have additional obligations regarding disclosure that are currently not required for sales to accredited investors only. So in that space, for CrowdCheck, our diligence process will help ensure that those disclosures are made and that, again, that there are no bad actors present. But it's something that it's uncertain how it's going to change the market. It is still our belief that when it comes to innovative companies and growth potential companies, they are going to remain in this realm of 506C general solicitations to accredited investors only. the requirements for going through non-accredited crowdfunding just don't work for companies that are high growth, but it is something that will likely be more focused on sort of retail and consumer-focused businesses.
Okay, I appreciate that. I want to talk for 1 sec about the CrowdCheck seal of approval, just to wrap things up here. I was reading in the Washington Business Journal. They quoted your CEO, Sarah Hanks, as quoting, quote, "You have liabilities, we can help you defeat them. You have obligations, we can help you meet them," end quote. Can you explain that process? For example, maybe give some examples of due diligence disclosure tasks or how to clean up a mess from a prior raise. And you've touched on that just a little, but maybe expound a little more. And how it would benefit an investor to have the CrowdCheck seal of approval before moving ahead.
So the historical cap table is one of the most common areas for finding mistakes in issues during the due diligence process. And it matters because it can impact the material information available about the company. For example, a common mistake is that in the past, somebody was provided with a percentage ownership rather than a number of shares, or that during previous issuances of securities, the company did not comply with preemptive rights or right of first refusal provisions that were previously provided, or they are not complying with those provisions in the offering that the issuer is currently making available to investors. So mistakes made there could call into question the accuracy of statements made by the issuer and certainly could impact investor decisions on whether or not to invest. So if an investor later learns that somebody had a larger stake than what that investor previously was led to believe, that's something that could have materially changed the investor's decision of whether or not to invest. And so those are all problems that need to be sort of caught and resolved before they occur. So we help companies identify sort of all their past issuances, whether they were approved by the board of directors, whether they were authorized by a corporation, whether in past subscription agreements, if obligations were provided, and if those obligations were met in later issuances. So that CrowdCheck seal of approval sort of helps investors know that somebody has looked at these issues. Somebody has gone through and at least asked the important questions and brought to the issuer's attention that, hey guys, you got to get this right before you go forward.
Sure, I think that's excellent advice. And that's one of the things that CrowdCheck is really making a name for itself in that space. And that seal of approval is something that's becoming associated with quality, I think, as far as the due diligence behind that. And I know that that's something that you strive for. And I appreciate you taking the time to talk with me today, Andrew, and expound on that. And I wanted to let our listeners know that they can find out more about Andrew and CrowdCheck by going to www.crowdcheck.com or view CrowdCheck's Twitter feed by visiting @CrowdCheck. Thanks, Andrew, for taking some time to talk with us today.
Thank you. Appreciate it.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.